Hello friends, today we will go through 8 main ideas that I have collected in Book Summary, The Psychology of Money by Morgan Housel. Key Idea 1. Everyone has their own experience of the economy and money. Each person has a unique perspective on the economy and money. The Great Depression's history is well recognized. A decade of consistent decline for the world economy followed the terrible 1929 stock market crash. The roaring 20s in the US abruptly came to an end. Hard-earned funds vanished into thin air, businesses failed, and families lost their farms and homes. While the belief that tomorrow would be better than today fell, poverty and unemployment rose sharply. This account of what happened is now accepted as fact. That makes sense because millions of Americans have experienced it. After all, however, it also neglects to include a crucial element. When John F. Kennedy ran for president in 1960, questions regarding the Great Depression were raised. Many voters were shocked by his response. He said that the Kennedys were already well off in 1929, and throughout the ensuing 10 years, their fortune did not disappear. Rather, it increased. The family had more staff and a larger home by 1939 than it had at the beginning of the decade. Only after enrolling at Harvard and reading about the Great Depression did he grasp the devastation that many of his fellow countrymen had endured. It came out that not all Americans had been in the same situation. Kennedy sought to alter that, which was one of the ways he persuaded voters that he wasn't simply an elitist out of touch but also a deserving president. But we all experience economic life differently. It's not only the rich and the poor. The son of a wealthy Manhattan stockbroker and the son of an unemployed farmhand not only come from different walks of life, but they also receive quite different lessons about risk and return when it comes to money. However, as we'll see in a moment, the same holds true for similarly wealthy people depending on their unique life circumstances. For instance, a wealthy person who experienced periods of high inflation while growing up will regard money differently than a person of comparable wealth who has only ever encountered stable pricing. What we do with money is shaped by the lessons that emerge from these various viewpoints. We all like to assume that we understand how the world operates, but the reality is usually much more nuanced than that. We know less than we'd like to think we do, and that is the first thing to comprehend when it comes to the psychology of money. Key Idea 2. Personal experience drives financial decision-making. When modeling financial behavior, economists frequently rely on a convenient fiction, irrational people who act in their own best interests by maximizing their returns. Of course, reality is a little messier than this simple concept. Think about something like the lottery. The average low-income household in the US spends $411 a year on lottery tickets. At the same time, 40% of all households struggle to come up with $400 in a pinch. Unsurprisingly, the same low-income households who spend slightly over $400 on lottery tickets make up this 40% of the population. Is this conduct reasonable? Hardly, but it's also not illogical. Living paycheck to paycheck makes it unlikely that you will have enough money for even necessities, let alone luxury like vacations. Playing the lottery is a long shot, but it's better than the alternative, which is having no chance of obtaining the nice things that people with more money take for granted. Unreasonable phone calls of this nature happen more frequently than you may imagine. Consider Ulrich Malmendier and Stefan Nagel's 2006 study on economics. They searched through data collected over a period of 50 years by the Survey of Consumer Finances, an ongoing study that looks at how Americans spend their money. Malmendier and Nagel sought to understand the factors that influence people's financial decisions. Their response? When the investors were young adults, how the economy was performing. In other words, our attitude toward danger is influenced by our personal histories. This isn't the kind of reasoning you find in economics textbooks, but it is intuitively obvious, like buying lottery tickets. For instance, investors were highly reluctant to make bond investments later in life if inflation was strong between their late teens and early 20s. Conversely, if inflation was low throughout these formative years, investors were content to keep investing in bonds as they grew older, regardless of whether inflation increased along the way. For stocks, a similar trend applies. Investors continued to invest in the stock market if it was performing well in their early adult years, but they avoided it if it was underperforming. Imagine that you were born in 1970. The S&P 500 surged tenfold between the middle of your adolescent years and early adulthood. Anyone who invested in the companies that were listed on that stock made a fortune. People born in 1950 experienced the market significantly differently because it was largely dormant throughout this time in their life. Importantly, judgments to invest or not didn't change even when the market did, indicating that empirical evidence did not influence early life instincts. Key idea 3. The economic concepts we use today are still historical infants. A toy poodle doesn't resemble its wild predecessors, who weren't all that different from wolves in the first place. This shouldn't come as a surprise to us because modern dog breeds have a 10,000-year domestication history, yet dog owners are frequently taken aback by their dog's murderous, natural reactions when they glimpse a cat or a squirrel. As it turns out, these deeply ingrained wild instincts haven't entirely disappeared after 10 millennia. But what is the relationship between dog domestication and the psychology of money? Actually, quite a lot. Why do so many of us handle money in such a poor way? One response is that, in the big scope of things, it is relatively new. The earliest coins were only produced by King Aliats of Lydia, an Iron Age country in modern-day Turkey, circa 600 BC, and those ideas pale in comparison to more advanced economic theories. Take a break. Most Americans worked until the time of their death prior to the Second World War. Of course, life expectancy was lower back then. But even so, in the 1940s, half of all males over the age of 65 were still actively employed. After World War II, Social Security was implemented, and things began to change. However, for the majority of American workers, retirement remained a distant dream until the 1980s, when the average monthly Social Security check increased to over $1,000 after adjusting for inflation. Only a wealthy minority could afford to retire in their mid-60s prior to that. Thus, one of the most fundamental economic ideas that we employ today is less than 2 generations old. The primary retirement funding mechanism, the 401k, didn't even exist until 1978, and the Roth IRA retirement plan wasn't even created until 1998. Other important principles and methods aren't much older. Index funds are barely 50 years old, but hedge funds didn't truly take off until a quarter of a century ago. Even consumer debt, which is one of the main factors in economic growth in the United States, didn't become widespread until the GI Bill made it simpler for regular Americans to take out loans in 1944. We aren't stupid if we make poor financial plans and decisions. Rather, it's just that we are novices. Key idea 4. Luck plays a bigger role in financial successes than you might think. The author once questioned Nobel Prize-winning economist Robert Shiller about the one thing he wishes he could fully understand about investment. Shiller's response was the exact role of luck in successful outcomes. Luck is a complex subject. Theoretically, few investors and business owners would contest its influence, but it can be difficult to determine how much one firm's success or failure is influenced by it. We also have a propensity to believe it is impolite to credit other people's success to pure luck. As a result, when it comes to making financial decisions, we frequently end up neglecting the importance of luck. That is incorrect. The wealth of 2 siblings is more closely associated than either height or weight, according to economist Bhaskar Mazumdar. To put it another way, if your brother is wealthy and tall, you are more likely to be wealthy than tall. This association can be explained quite simply. It's conceivable that siblings from the same home will have access to the same opportunities and privileges. Parents that enroll one child in a reputable school typically also enroll his brother. But if you find 2 wealthy brothers, you'll find 2 people who don't think. Mazumdar's research pertains to their family. That has to do with how people think. Usually, we either overestimate or undervalue the impact of luck on results. If we succeed, it is because of our diligence. If we fail, it is due to bad luck. However, we aren't nearly as forgiving if others fail. In certain circumstances, we don't blame failure. Unfortunately, our success-obsessed culture isn't much of a help in this regard. Brilliant investors who lost everything because they were unlucky and the market suddenly tanked aren't celebrated by Forbes. However, it does honor poor or careless investors who struck it rich by luck. That puts us in a bind. We need a means to incorporate randomness into our models when it comes to money in addition to determining what works and what doesn't. Shiller's wish to account for the exact role of chance may be beyond our ability. But as we'll see, we may still understand luck. Key idea 5. Focusing on broad patterns rather than specific cases can help you make better calls. Success is a terrible teacher, as Bill Gates famously remarked. According to Gates, success deceives intelligent people into ignoring the significance of luck, leading them to believe they are impervious to loss. In a paradoxical manner, doing that almost guarantees that you will lose. So how can you include luck and chance into your financial behavior? So, here's what you shouldn't do. Fixate on the instances of certain people. When we research highly successful people, we frequently choose outliers, billionaires who have altered how the world functions, and this might mislead us. Consider John D. Rockefeller, one of the most prosperous businessmen ever. He ran into an issue when he was developing his petroleum industry. He was unable to carry out his plan since it was against American law. His simple approach was to ignore them. He actually showed such a complete disdain for legal precedent that one court remarked that his company acted no better than a common thief. The success of Rockefeller influences how we view this conduct. Looking back, it's simple to praise his vision and point out that he steadfastly resisted allowing antiquated restrictions to stifle progress. Would we still believe that Rockefeller's example is one we should follow if he had failed? Most likely not. At most, we would perceive him as a failed criminal who showed us what not to do. But when it comes down to it, luck determines which of these two eventualities will occur. Rockefeller's fortunes could have been changed by a few different decisions here and there, or possibly by a shift in the political landscape. More importantly, achieving good fortune is virtually difficult. You can't guarantee the dice will fall for you in the same manner as they did for Warren Buffett, even if you follow his career path step by step. The alternative is to continue looking at patterns of success and failure. The more prevalent a pattern, the more probable it is to apply to your financial and personal choices. For instance, study after study demonstrates that people who have control over the schedule of their days are more content with their jobs than those who don't, in contrast to the rare instances of extreme outliers. That is a general observation you may use straight away. Key idea 6. Envy can make you reckless. Capitalism excels at two things: generating wealth and fostering envy. Consider a rookie baseball player earning $500,000 annually. By all reasonable measures, he is wealthy. However, if he plays on the same team as a superstar like Mike Trout, who earns $36 million per year, suddenly he is dissatisfied with his earnings and desires what others have. Meanwhile, high earners like Trout compare themselves to those who earn even more. To make it onto the list of America's top 10 highest paid hedge fund managers in 2018, for instance, one had to have earned at least $340 million that year. Even Trout is insignificant by that standard. From a capitalist perspective, there is nothing inherently wrong with envy. However, there is a practical issue. When is enough enough? Just ask Rajat Gupta. Rajat Gupta, born in a slum in Kolkata, India, worked his way up the corporate ladder to become the CEO of management consulting firm McKinsey. When he retired in 2007, he was worth $100 million. He could have done anything, but Gupta was envious. He wanted to be a billionaire. In 2008, Gupta, a member of the board of directors at Goldman Sachs, learned that Warren Buffett was about to invest $5 billion to keep the firm afloat during the financial crisis. 16 seconds after hearing this news on a conference call, long before it was made public, Gupta dialed the number of a hedge fund manager and bought 175,000 shares of Goldman Sachs. This was insider trading and strictly illegal. Gupta didn't care. He had just made an easy $1 million. By the time prosecutors caught up with him, he had racked up $17 million in a string of dodgy deals. It hadn't made him a billionaire, but it was enough to earn him a hefty prison sentence. The moral of this story is that envy can lead to bad decisions, and the consequences of those decisions can be much greater than any potential benefits. It's like having an insatiable appetite. You may eat until you're sick, but throwing up is much worse than any meal is good, so you avoid it. Similarly, leaving some opportunities on the table doesn't necessarily mean you're missing out. It can be a recognition that trying to take advantage of everything will only lead to regret. In short, don't be like Rajat Gupta. Key idea 7. Amassing a fortune is easier than keeping hold of it. Jesse Livermore was one of the most skilled stock market traders in early 20th century America. He was born in 1877 and played a significant role in building Wall Street. By the time he turned 30, he had amassed a fortune of $100 million in today's currency. Just before the 1929 crash, Livermore made a wise decision that proved to be the best of his career. He took a short position and predicted that stocks would decline. As expected, the market lost 1/3 of its total value. While many investors went bankrupt and some even jumped from office windows, Livermore returned home to his family with fantastic news. He had just earned the modern equivalent of $3 billion. However, the story doesn't end happily ever after. Remember what we said about success being a lousy teacher? Well, after his big win in 1929, Livermore thought he was untouchable. He placed larger and larger bets and lost big again and again, until his fortune was gone, broke and indebted. He took his own life in a Manhattan club in 1940. It turns out that getting rich is sometimes a lot simpler than staying rich. It's easy to see why people who are good at the former often struggle with the latter. Making money is all about risk, optimism, and courage. Keeping money is an entirely different psychological ballgame. It's about the fear that everything you've made could be taken away. Staying rich also means being humble. After 1929, Livermore thought he was a genius who couldn't take a wrong step. He would have been better off recognizing that luck had played its part and that his success couldn't be repeated indefinitely. There are many Livermores out there, although their stories are not typically as tragic. Approximately 40% of all publicly listed companies lose their entire value over time. Additionally, the Forbes 400 list of America's wealthiest individuals experiences a 20% turnover per decade, excluding instances of death and intra-family transfers. So, how can you maintain what you already possess? The answer is perseverance. The entrepreneurs who succeed the most are those who persist for a long time without experiencing failure. They all share a common trait known as fear. According to Michael Moritz, a multi-billionaire venture capitalist, when you are afraid of losing, you view potential gains through a different perspective. Few rewards are significant enough to warrant risking everything you already have. When you adopt this mindset, you are more likely to make better decisions. Key idea 8. You can be wrong half the time and still make a fortune. According to his own account, Heinz Berggruen did not show much promise in his youth. When he was forced to flee Nazi Germany in 1936, he was unsure of what to do with his life. After studying literature at the University of California, Berkeley, he worked as a journalist with a sideline in art criticism. In 1940, he purchased a small watercolor by an artist named Paul Klee for $100. This was the beginning of his lifelong passion for modern art. Fast forward to the 1990s, and Berggruen had become one of the most successful art collectors of all time. In 2000, he sold his collection to the German government for 100 million euros. Given that it contained a large number of Picassos, Klees, Matisses, and Braques, that figure was nowhere close to its real worth, which was estimated at $1 billion. It was one of the most important collections in the world. How did Berggruen manage to accumulate such an impressive collection of the greatest artists of the 20th century? Was it his skill or just pure luck? According to Horizon Research, an investment firm, the answer is more intriguing than that. Based on the company's research, all great collectors have one thing in common: they purchase vast quantities of art. Some of these acquisitions turn out to be excellent investments, particularly if the collector holds onto them for an extended period. However, the majority of them are not successful. As Horizon's report points out, the key is to keep the successful investments until the portfolio return, which is the value of the entire collection, converges upon the return of the best elements in the portfolio. Berggruen's collection was similar to an index fund, with his risks evenly distributed across a broad range of investments. Instead of only purchasing pieces that he liked or admired, he acquired everything he could and waited for a few winners to emerge. This strategy applies to all investments. It's called the long tail, which refers to the tendency of a small number of events accounting for the majority of outcomes. Although there is complicated math behind this principle, it can be simplified to its essentials. Essentially, if you get a few things right, you can afford to get more things wrong. Failure is inevitable, but the nature of your successes is what really matters. In other words, if you have one Picasso, you don't have to worry about the 99 duds in your collection. Final summary. Financial decision-making can be much more complicated in reality than it appears in economics textbooks. Many choices, such as purchasing lottery tickets when you're short on funds, may not be logical, but they do have their own reasoning. The same is true for investment decisions, which are frequently influenced by individuals' early experiences with the economy rather than objective evaluations of current market conditions. In short, Financial decisions are intertwined with psychological elements. So, what is the best course of action? Acknowledge that chance plays a part in success, develop a fear of losing what you already possess, and diversify your investments. Dear friends, I have just sent you the 8 main ideas of the psychology of money by Morgan Housel. Please subscribe and ring the bell so you don't miss my new videos. Hello and goodbye.